A few years ago, in March of 2020, unemployment in the United States reached 15% because of the fallout. Many businesses were forced to close due to the coronavirus, and many more are expected to implement drastic cost-cutting measures to weather the coming storm. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Today, thanks in part to the government stimulus and a new workplace acceptance of the status quo, this figure has fallen to 6%, which is still significantly higher than the 3.5% that existed prior to the economy's shutdown. However, it is clearly a significant improvement. In fact, the United States is currently dealing with a completely different paradoxical problem. People are no longer struggling to find jobs. Rather, workplaces are struggling to find workers. In Australia, Uber is offering a $500 bonus for signing up as a driver and making 20 deliveries. Furthermore, those same companies are being forced to offer higher salaries and opportunities for advancement beyond the minimum wage they have traditionally paid to entry-level employees. These positive headlines have given some economists some doubt. To understand why, we must examine a few details in order to fully comprehend what this could all mean for the recovery of the American economy. So, why are economists concerned about people being able to choose jobs with better pay and conditions? What impact could this situation have on the overall economy? And what is the best way to capitalize on the apparent increase in demand for new employees? People have heard the phrase full employment. The phrase full employment is a little misleading. You would be forgiven for thinking that this means no joblessness, but it doesn't. What exactly does this mean? Economists agree that the unemployment rate is low, but it will never be zero. The first approach is based on what is known as the natural rate of unemployment. This means that the only people who are willing and able to work but are not currently doing so are either in between jobs or training for a different role. This is known as frictional and structural unemployment and is considered to be the better type of unemployment. We are usually concerned about cyclical unemployment. This is the result of changes in the business cycle. When an economy enters a recession, demand naturally falls, which means fewer employees are required to meet the lower level of demand. People are laid off and lose their income, so they can't buy as much, which reduces demand and the vicious cycle continues. To try to avoid this, the central bank is tasked with, among other things, ensuring full employment. However, this role can sometimes clash with the Fed's other responsibility, which is to keep inflation low. There is another definition of full employment. The NAIRU stands for the Non-Accelerating Inflation Rate of Unemployment. Therefore, economists do not advocate for zero unemployment. William Phillips discovered that there was a relationship between the unemployment rate and inflation. Significantly higher levels of unemployment correlate with higher levels of inflation. However, it is not a linear relationship. As employment levels rise, so does inflation. However, inflation only becomes a problem when it approaches a point known as the NAIRU, considered a word with 10% unemployment. If you are the unlucky one out of every 10 who is out of work involuntarily, you're in trouble. Any job opening will attract a large number of applicants willing to work for low pay. Finally, the labor market is just like any other market. And because there are more people looking for fewer jobs, there is more supply, less demand, and lower wages. The inverse is also true, but to a greater extent. If your unemployment falls below this NAIRU level, we will have a situation in which almost everyone who wants a job has one. If you're an employer and post a job opening, you may receive no applications. As a result, you must offer a slightly higher salary or attract employees from other companies with attractive signing bonuses. A little of this is good because it gives the labor pool some bargaining power. It means that people don't have to work too hard, which could harm their long-term health. But too much can be harmful. There is certainly a case to be made for a higher minimum wage. But what if restaurants have to turn around and start paying all of their employees a large sum of money per hour just to attract enough staff to keep the operation running? These businesses' salary expenses would eventually make it impossible for them to continue operating. As a result, they will close down, reducing supply. This is, of course, an extreme example, but even gradual increases in income can result in gradual increases in the price level of goods and services. There is more to this issue than just inflation alone. This ignores the fact that unemployment is still nearly double what it was before the pandemic. Why is this a problem now if it wasn't a problem before? The short answer is that the NAIRU has shifted, but only when the larger picture is considered. For a variety of reasons, you will never see a politician campaign on a platform of increasing unemployment and providing fewer jobs to fewer Americans. However, increasing unemployment is a simple matter. It's as easy as scrapping a few government projects. The challenge is to keep unemployment as low as possible while avoiding excessive debt or inflation. Because it is politically popular, the government works hard to keep this figure as low as possible. This is accomplished either directly by hiring people in the government roles as government contractors, or indirectly by running an expansionary fiscal budget in which little money is taxed but much money is given away. The issue with the second option is that it has the potential to create a whole new category of unemployment that does not receive nearly as much attention as the others. Institutional unemployment is defined as unemployment caused by institutional policies that have an impact on the labor market. This can range from a mine being closed down because workers threaten to unionize to companies refusing to hire people of a certain race or gender, but it is more commonly associated with the government intervention in markets. Unemployment insurance combined with weekly supplements of up to $300. People are making more money by not working than they would in industries that are suffering as a result of multiple checks. When you consider that going to work also includes hidden costs such as paying for transportation to and from work. And also, there is still a global pandemic going on. Given the current state of the world, you'd have to pay people a pretty healthy premium for taking a risk. This entire process effectively means that the unemployment rate's non-accelerating inflation rate can shift. Following the 2008 recession, this rate increased by 1% to slightly less than 6%. Of course, that was never a problem because unemployment was hovering around 8% at the time. Given the real material constraints on the economy, we are now in a potentially worse economic situation than we were back then. We do not have enough resources to run an economy. It does make sense that unemployment would be higher. A rough analogy would be a covert attack on the global economy. There are two options for dealing with this. Try to make yourself feel better and move on, or simply think of something else. But it will only help in the short term, and it will inevitably make things worse in the long run. Some argue that this is simply a systematic problem that will be resolved over time. When you look at the numbers, this makes sense. As we saw during the pandemic's peak, millions of people were laid off in a very short period of time. Most people have had to find alternative means of support in the past months. This could range from returning to school, to receiving government assistance, to simply finding a new job. Fast forward to today, and those same businesses are reopening and looking to rebuild their staff bases, only to discover that all of the people they let go had found other employment. Right now, job openings are at an all-time high. And while some of those who were laid off will be happy or forced to return to work, others will stick with the alternatives they discovered during the lockdown. Over time, this will even out. And what can you do to take advantage of all of this? Now is an excellent time to begin looking for a new job with a higher salary. For the first time in a long time, it is the employers fighting over the employees rather than the other way around. According to studies, employees who stay with their companies for more than 2 years are paid 50% less than their peers who are more willing to job hop for a promotion, a pay raise, or simply better working conditions. Getting the most out of your hard work is always a good idea, but perhaps never more so than right now. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.